Hi guys, Oleg Tkach here with NFM Lending, and in this industry we are known as a team for saving impossible deals. And what I mean by impossible deals are deals that are under contract. They might have a closing date of a week or tomorrow and their lender denied them. And they reach out to us and say, save our deal, make it happen. Can you make it happen? Can you save this deal that's already in the works? And then we jump in. So what I want to showcase today was the 3 deals that we saved as a team in January. Our first scenario was a VA loan that was turned down by a different lender due to excessive debt to income ratios. Now, on conventional loans, typically you could go up to 49.99% on debt to income, which is how much money you make compared to how much money you spend per month. On FHA loans, the back-end ratio could be 56%. Now, what a lot of people don't realize is VA actually has no maximum debt to income ratio that they really shoot for. It's more about the residual income that the person has. So when we saw this file, the debt to income ratio was 72%. Now, 72% DTI, for most people, they're gonna look at that and say no chance. However, with our extensive knowledge in VA, we knew that as long as we get the automated underwriting approvals, as long as we meet the residual income guidelines, and as long as we build the case for it, we would get our underwriter sign off on it, which is exactly what we did, and we were able to turn a turn down into a happy, successful client that ended up closing. The second scenario that we have is a family that also was turned down due to their debt to income ratio. Now, their scenario is different. The spouse's income was not able to be used due to the fact that they could not establish a long enough history. The spouse had been in the country for less than 2 years. They had only W-2 earnings for the last 6 months. And so because of that, what we did is we went back and documented income from the country that they came from and pretty much established a 2-year history. And because we were able to establish a 2-year history, we were able to use that income. And because of that additional income, we were able to make the deal work. It was just a matter of going deeper, asking more questions, going outside the box, getting translated documents. And because we were able to do that, when the other lender said, hey, sorry, it's not going to work, we were able to make it happen because we went that extra mile for them. Our last scenario was a self-employed borrower that during the process happened to obtain some new debt that did not show up on their credit until later on. With that said, we went from an acceptable debt to income ratio to one that wasn't, and therefore the other lender declined them and they weren't able to pay off the debt. When we saw the file, we analyzed it and we realized some of the debt was paid by the business, and we were able to document the business debt that was paid, which is not needed to be included in their debt to income ratio, and because of that, we were able to exclude most of their debts and get their debt to income ratio back in line, and we were able to get them closed in a little more than a week. Now, how are we able to do this and other lenders can't? Well, technically, it's because of the guidelines. Most lenders don't understand guidelines on a super high level. And more so, most lenders view guidelines as everything they can't do on a file, whereas we have an underwriting philosophy on our team of the guidelines show us the way. If we know the guidelines well enough, that opens the door to how we can do deals. And that's really what it comes down to. It has to do with our underwriting approach to understanding guidelines at a super high level that allows us to use them to help more people obtain ownership. And that's really what it is at the end of the day, simply that. Now, most of these deals close in less than 2 weeks. It just depends on how far along they are and how fast somebody needs to close. In addition to that, doing this for years and years and years has earned us the ability to be the preferred backup lender to Richmond American Homes, and we're known for saving a lot of their super tough deals and so forth. So next time you run into a scenario that you need an expert opinion on, a second opinion on, or maybe it's a deal that's falling apart in escrow right now, give us a call. Most of the time we're able to find a solution and help you win another transaction and win another client over. Now, in addition to saving their deals and helping them purchase the homes that they're under contract on, those 3 buyers also got our REFI pledge. And what is our REFI pledge? Well, it's a promo that we're running right now for any buyers that purchase with us that get under contract by 3/23/2023. They're going to get a free future refinance from us that covers them for the next 5 years. Now, what does the free refi mean? It means there's no lender fees, there is no appraisal, we pay for the appraisal, they only have to pay title and escrow and any prepaid items. And so anybody that you have right now also it's kind of on the fence that works with us, just know they're going to get our refi pledge as well, regardless how challenging their file was. Now the refi pledge is a major benefit for anybody that takes advantage of it. Ultimately speaking, rates are not going to stay high forever. This allows people when rates come down to get a quick a low-cost refinance and drop their mortgage payment, which is something that really is a big, you could say, hurdle for most clients that are thinking about buying right now. They maybe are on the fence right now. It really helps you overcome that because it gives them a way to lower their payment in the future. So with that said, utilize the refi pledge. Use us as a resource to help you with any challenging scenarios you have. My team and I are here to help. We're here to help you become more successful in 2023. Don't hesitate to reach out to us at 425-478-7676. Hope you have a good one.